Downbeat week for the bulls, but the major averages are tracking to close out the month of May in the green. Our next guest says more volatility could be on the way. Joining us now is Joe Amato from Neuberger Berman. The firm oversees $474 billion in assets. Joe, certainly got some volatility here in overtime. Yesterday, it was Salesforce. Today, Dell and MongoDB are down big, but Zscaler is up 14.5%. Elastic is higher as well. What's driving the volatility that you see ahead?
Hi, John. Nice to be with you this afternoon. I think the volatility that you're seeing in some of the stocks you referenced is probably more a function of the dispersion going on in the economy really below the surface. And as much as we're confident on overall levels of economic growth, first quarter was okay. Second quarter seems to be running at a reasonable clip. Below the surface, there's still a lot of grinding that's going on. There are companies that are doing well, companies that are doing poorly, and that bifurcation, I think, is only going to continue and create additional volatility. If you look at earnings of large cap companies, right, the first quarter earnings by and large were pretty strong, right? They were up high single digits. But if you look at small caps, right, the Russell 2000 earnings were down about 9% in the first quarter. So that gives you an indication of the level of sort of bifurcation going on and dispersion going on in the economy.
So in this environment, how do you decide what the fair price to pay for hypothetical future earnings or even real future earnings, especially for smaller caps when you don't know where interest rates are going to be?
Well, certainly we do a lot of bottom-up fundamental work on individual companies. And, not every company is driven just by interest rates. Certainly interest rates and the level of interest rates have an effect in the tightening of financial conditions that we've seen over the course of the last 18 months or so is certainly having its effect, particularly on smaller companies. And that's a big reason why you're seeing this bifurcation. But we take a very long-term approach, and we think, the direction of travel on inflation is lower. May take longer, as you guys have certainly talked about. We think the direction of travel on rates is lower. And I think from a long-term standpoint, from an equity perspective, we think that creates a reasonably constructive environment for risk-taking.
How should we be thinking about the fiscal spending environment here? Because on the one hand, you can argue that it's helping to buoy economic growth. Yes, I realize the first quarter GDP number was just revised slightly lower, but it's been a big part of that, those government dollars that have gone out into parts of the economy with some of these mega infrastructure projects and the like that are starting to be carried out. On the other hand, it means a lot more borrowing, and we're seeing that impact in the bond market, too.
Morgan, you raise a really important point. The whole question of debt sustainability, I think, is going to rear its ugly head at some point. And I think right now many are sort of watching this political environment closely, trying to gauge what's going to happen in November. And then once that's decided, you'll have a better sense for, okay, what's the fiscal outlook? Will you have an extension of tax cuts? Will you have more spending? Will you have some level of fiscal discipline? And I think that's a big issue that's hanging out there, and one that we worry a lot about right now. And over the course of the last couple of years, the fiscal spend has certainly helped, as you say, buoy economic growth, but you can't do that forever. And the debt levels as a percent of GDP, if you continue the spending trends you're seeing right now, is going to be a pretty ugly picture going out 10, 20 years from now. So it's clearly not something that we think makes a lot of sense. And the politicians are going to have to come together and figure out how to create a more disciplined fiscal picture.
So the last time you were on with us, we asked you about Disney because we had that very heated proxy fight. Nelson Peltz, your firm had come out and basically supported the Peltz position on Disney. We get the news in the last, call it 12, 24 hours, that Peltz has sold out of his stake of Disney. Just want to get your thoughts on that and perhaps more broadly what this proxy season and what the increase in activist investor pressures on companies has meant for stocks.
Well, I don't really have a comment on what Nelson did with his stock. Best to reach out to him. But I think the larger picture is, look, we take our role as owners of companies really, really seriously, right? We want to be very engaged with companies. In the case of Disney, that issue was around, in our view, the important decision the board had to make on succession at some point down the road who is going to succeed Bob Iger. And as has been much talked about, the last decision that board made was not a particularly good one. So we felt that another set of independent eyes and ears in the context of those board discussions as it relates to the succession plan made a lot of sense. We think ultimately choosing the CEO is probably the most important job for a board of directors. I think broadly in the context of the proxy season, you're certainly seeing much more engagement from shareholders with companies and vice versa, which we think is a great thing. As you've seen passive increase their ownership of companies, most companies may be 30% owned by passive investors, right? That's not really active engagement. And we think it's an important element of the efficient capital allocation process for shareholders, active shareholders like us, to engage with companies.